Why are people trading? It's just obvious. The buy and hold equation doesn't work at the moment for a lot of investors. People are still really interested in property as an asset class. The market is not as dead as everyone will have you think it is. And there's opportunity. And wherever there's opportunity in the market, people will take advantage of it.
Welcome to Checks and Balances, brought to you by Partners Life. I'm Michael Vincent. This is James Blair. And today we've got the property guru himself, Matthew Harris, here to talk about is now the perfect time to start flipping properties.
So Matt, welcome back to the podcast. Been a little while. Talking about property flipping today.
Yeah, look, thank you for having me back. It has been a while, but I always run in the door really quickly when you want to talk about property.
So why are we talking about property flipping?
Well, I mean, I think property is always a hot topic in New Zealand. It's still one of the main asset classes that we invest in, despite the headwinds that we've been facing lately. A lot of people,
It's been windy.
Very much.
Yeah.
Yep. A lot of people have still been investing where they can, and it's still a large part of the psyche of New Zealand. So I think that's fundamentally why we're talking about it. But I think the more specific than that is that right now we are seeing a lot more people trading property than we have in say, the last 4 years.
Yeah. And if we talk about a couple of those headwinds quickly, high interest rates, so your holding costs, if you're holding properties quite long, and declining house values, right? So if you were thinking about trading a property, you're going to buy and sell quite quickly. If the value's going down, maybe not the best time to do it.
Yeah, and you know what's wild about declining house values is that it happens.
We have less money.
Yeah. Well, people definitely feel less wealthy, even though we all know it's on paper. But the reality of it is, as Mike will really well know, is that you can unlock that wealth and use it for all sorts of things. So you are actually less wealthy. But theoretically, inflation should help property prices. But you have this really weird situation where the price of everything except property is going one way. And so it's costing you more to live, but you're getting poorer as you go. So I think it really affects people's psyche.
So why do you think property flipping has picked up a little bit?
Yeah, I think it's pretty obvious, really, is that the buy and hold equation currently doesn't work. Interest rates are really high. Rents are not increasing anywhere near as quick as costs are, because those costs that are increasing in everyday life include insurance, include rates, repairs. Any repair and maintenance has a higher cost, all that stuff that erodes away at the return of a property. And when you buy and hold property, which is a wealth creation play that we talk about a lot in this office, you're effectively waiting to add value. A lot of the time, buy them well. You're waiting for capital appreciation to occur, and you're trying to maximize the cash flow and minimize the expenses. And then you hold on for a very long time. When you've got really high interest rates and really high costs, the holding on part actually becomes really difficult. And people look at it and they go, okay, well, what can I do differently to make that journey a bit easier? And the obvious one is get more cash flow.
Yeah. So what is flipping a property? Let's start there.
Yeah, so there's lots of ways to do it, but at its core, it's buying a property and selling it again in a short period of time.
Yeah.
I was going to say add some value, but to be honest, you don't even have to do that a lot of the time if you buy in the right place. But it's a quick turnover property transaction that has entered into with the intention of making money.
Yeah.
In theory, it sounds great. I'm just going to make some money real quick.
Yeah. Yeah, and some people do. And if the market's right for it, and the best time to do it is on the start of a rising market, before everyone else has jumped in. But you can do it at any time as long as you get your calculations right. So it is great. When you look at it, it's a cash flow play. So when you buy and hold property, it's a wealth creation over time play. When you trade properties, it's just income.
Yeah. So one of the reasons why it might be a good time to buy, when we're talking about just before everyone else gets in the market and it takes off, Matt talked about two strategies there. One where you buy really well, you don't add value, but you sell it again in a pretty short amount of time to make some income. The other one is you add value to the house. You give it a spruce up, lick a paint, carpet, all that sort of good stuff. It takes more effort. At the moment, if we are right before the property market is about to kick off again, you're more likely to be able to buy a better deal so you don't have to do the adding value piece.
Yeah, and I've seen a lot of them lately, the contemporaneous settlements or nominations.
I want to talk about this because this gets risky, but let's keep going.
Yeah, well, definitely. And the whole thing, let's be clear, trading properties has a huge amount more inherent risk than buying and holding. And that's simply because time can undo a lot of issues that you have or right a lot of wrongs in your transaction. But when you trade a property in the short term, 3 to 6 months, you have a very little window to get it right.
Yeah.
But I think, back to the question, why are people trading? It's just obvious. The buy and hold equation doesn't work at the moment for a lot of investors. People are still really interested in property as an asset class. The market is not as dead as everyone will have you think it is. And there's opportunity. And whenever there's opportunity in the market, people will take advantage of it.
How long I'm just thinking, like, I'll use your place in Koe as an example. Like, you bought that well on the market. And then
500 grand on the market.
And then you could add some value to it if you chose to, and then flip it. And the other thing that would make it better is if you gave it a bit more time, right, for the market to continue to move. How long do you have to hold for it to be the longest that it can be considered?
So this is a great example. So I always tell people the easiest way to make money in a property transaction is buying well.
Yeah.
And that's a really great example of it. But there's two types of money that get made. So in a market like we're in right now, the money Mike has made is on paper. And so the great example is if he waits 6 months to 2 years, that will not just be on paper anymore, because he probably can't sell it right now for 500 grand more than he bought it for, even though the bank would recognize that that's the value. But in 2 years, he almost certainly will be able to, because the market would have caught up and it comes back to its true value. And that's where you can make really good gains if you're going to go back into the buy and hold area.
Another example is Upper Hutt in terms of the deal that we're doing.
Yeah.
Like, we've bought under market, we've renovated it. Now, we could very easily, and we had the conversation going, do we just sell this and walk away with, I don't know, $500,000 to $700,000, $800,000, and going, well, actually, this thing is paying really good rent. If we wait till past the bright line period, then we've got no tax implications a couple of years down the road, and then we can reassess then.
So you've just hit on a great point. The fundamental difference that people who are going to go trade have to get their head around is that if you're a buy and hold property investor, you're virtually untaxed in your growth over time, provided that you hold a property outside the bright line period, which is now back to 2 years, which is a really great time frame, stops short-term speculation, but allows flexibility. You can unlock those gains tax-free in a very short period of time. But if you're trading property, you are subject to income tax on the profit in every case. And in addition to that, you're also going to be subject to GST.
Ooh.
But you claim the GST back at the start?
You do. You claim. So how it works is, in the ordinary course of a trade, you will be able to claim the GST on the purchase. That will give you 15%. That's quite good for traders. They can use that cash refund to quite often pay for the trades that they need to undertake, painting, carpet laying, builder, etc. They get to claim all those costs as they run through. But then when they sell, it's a bit of a double-edged sword. So GST is just a cash flow advantage, but it's a consumption tax. So it gets passed basically to the end person in the chain, and you will pay GST on your sale price. All things being equal, you're going to make a gain because that's what you're doing it for. So you're going to pay 15% of your gain in GST.
So you get 15% back on hopefully a lower price than the high. You pay 15% on 15% on the higher price.
Correct.
So you want to have a good reason of why you're going to do that.
Yeah, exactly. So like, just really, if we're going to use simple math to illustrate, it's a little more complex because it's inclusive, exclusive. But if you make 100 grand profit, 15K of that's going to go to GST.
So James, before we continue, I have got a special announcement.
Have you started sticking to your budget?
Absolutely not.
You finally made it as an after-hours DJ.
I wish. Mate, the thing is, we have got a brand new podcast partner, Partners Life.
You mean the award-winning insurance provider with over 300,000 Kiwis insured?
Yep, they're also a New Zealand-operated company, and they are passionate about increasing financial literacy amongst Kiwis.
Sounds like a great match. Where can I learn more about them?
Check out their website in our show notes below.
Really thought DJ Magic Mike was going to be a global sensation.
So we've talked a bit about, the least risky strategy with the most of the cost. That's the buy and hold, the long-termers. We've then got the medium-term strategies, the buy, renovate a little bit, and then sell, or buy really well and then sell in a short period of time. I want to dial the risk up again. Now, people love talking about the fancy stuff in finance, and contemporaneous settlements are one of those things that people love. Matt, explain to me what a contemporaneous settlement is and why would this be relevant to flipping properties?
Yep. So a contemporaneous settlement is basically when, so imagine Mike buys a property, and he immediately on settlement day sells it to James. for more money usually. But you can get contempts where it's literally no more money because they want to get out of it or whatever. But basically, it's when there's two ways of doing it. One is you don't settle the property; it just nominates through. The other is when you settle the property and then you immediately on sell it. From Inland Revenue's perspective, there's actually very little difference to those two things. You're taxed regardless. But it's used by a lot of people out there, so we call them property finders. And they go out and their basically job or profession or their business is to go find people who are selling properties, get them under contract, and try and resell them to someone else. And so for example, there's groups of people who may want to do trades, might have the capital, but they don't have the wherewithal to go find properties. This is where the kind of space where these guys play. And to be honest, if you're good at it, it's a good way to make money, and you can make between $20,000 to $100,000
per transaction.
Per transaction, but it's very risky.
It is. Now, some people, when they are thinking about flipping, let's say Matt's selling a house. I reckon I could spend 30 grand on this and get 100K of value out of it, but I maybe don't have the backing to purchase it and then to sell it again. And I think I can sell it to James. So what I might do is say, Matt, I'll take it off your hands at 500K, right? Give me 6 weeks to settle the property until I have to pay you. Here's a deposit. And give me early access to the property so that I can do some renovations because, I want to renovate it and move in, right? So then I undertake the renovations on the property. I get all my tradies in, we rip everything out, give it a lick of paint. And at the same time, I'm trying to sell the finished product while we are waiting to settle. I then hopefully can sell it to James for a profit on the same day. So that is a contemporaneous flip. And boy, oh boy, is that a bit of risk.
But it works. And to the right people who do it.
It works
right.
if it works.
But there's risk reward, right?
Risk reward.
Because it's not much cash down. You're not paying a whole lot of interest. You don't have to settle the property, and if you do it well, you can nail it.
And the early access clause is really, you have to have that if you want to do that successfully.
And what happens if it doesn't work? How does it go to custard?
Sometimes, there's a lot of ways it can go to custard. Like the works can take longer. You can stuff it up. You can start pulling the house apart and actually, holy crap, like we didn't know there was black mold in
the
here
other
or
big
something.
one is you don't find me. So you think that you can on-sell it to someone else.
Or the market starts to go the other way, which happened a couple of years ago.
2021, 2022.
We're caught and they can't sell for the value they need to. And one other big one is that the people who bought it to do this actually could never have settled it either way. So they can't settle. And so the vendor's screaming for settlement. They're getting late penalties. Best case scenario, they forfeit their deposit. The vendor takes it back. Worst case scenario, the vendor sues them and they owe them all the money.
And you are, if you're late on settlement, you're looking at probably 15% interest on the entire shooting match. And we were calculating one for someone the other day because they were purchasing a property and they were late and the seller couldn't sell. They were late and it was like something about $450 a day. In late penalty interest, so it can really stack up.
And in your example, you've already spent 30 or 40 grand like renovating the property in the early access period, so you're really in trouble.
And so we do hear people talking about this quite a bit, and it's sexy, right? It's got like the moving bits, and you make a whole lot of money really quickly. If you need advice, you need to be a professional to do this sort of thing. You have got to know what you're doing, what to look out for with the property, because like we say, high reward, high risk.
If a client comes in here and they're a first-time property investor or even a second-time property investor and they come across my desk with something like that, there's a long conversation had about whether this is the right choice, whether this meets the goal. So they might have to go talk to James because people will see the flashiness of it and the quick money and they'll try step outside of their plan.
I think that's a really good point on the flashiness, the money quickly is property flipping could be argued as like a get rich quick type vibe. And it can be you have the skill set, you know what you're looking for, you can roll through this with a high probability of success. Or there's people who see somebody on Instagram or a mate's done it or whatever, and in a rising market, and they just go,
can't lose.
This can't be this complicated, can it?
I got a mate who's a builder. He's done like 4 of these.
And there's plenty of people on Instagram at the moment like making it look sexy. And I always we also know of property developers, for example, that made it look really glamorous over the last few years. But the reality of property development is that it's very difficult and a lot of risk.
Yeah.
And I'd love to know, how there's stats between like day trader success versus long time investments. Day traders just don't win on average.
Yeah.
I wonder what it's like with property traders. Probably pretty similar.
I tell you what, I've spoken to the property flippers where it hasn't worked out, where especially like, I don't even like the math on how you could be a successful property flipper when the market drops 20%.
Yeah.
Like if you're going, I'm going to add more than 20% value to this house after my costs. Like property flipping in a downward market is just a hiding, isn't it?
Yeah, it is. And I've seen some disasters. So when I look at it with clients, by far my preference is for clients to buy and hold. Low taxation to no taxation, wealth creation over time. You can still add value. You can still do lots of things you'd do in a flip, but the risk is far less.
Yeah.
The only risk really usually falls on the individual. Can they stay healthy? Can they retain their job, their marriage, that kind of thing?
Retain the marriage is an important one.
It is an important one. Happy wife, happy life.
Yeah. Congratulations on your engagement, by the way.
Thank you.
Yeah. Some were concerned that you actually just couldn't get up because of the bad knee.
Yeah.
So it's actually good.
I think she was concerned, but also I'd like to refer to it as part 2 of the trial.
We'll cancel that bit from the episode.
When you look at it, when I look at people who come to trade, I go, Cole, the plan better be, I've got 3 or 4 buy and holds. I can't service any more buy and holds. I'm going to do a couple of trades to either accumulate more deposits so I can get a servicing to work or pay down debt on existing.
Yeah.
I think that's a really complementary approach. If you're just going to go out to trade properties and try and make that your income, I'd say 1 in 10 people succeed at that.
Yeah.
Very interesting. And the other thing I think about, if you're going, listening to this episode and be like, property, I'm ready to get rich. Like the first thing click on our bio below for our free course.
Yeah.
Use the code MikeRich10.
Yeah. For 2 off.
First 2 properties guaranteed.
We'll guarantee the rental yield. Now, the first thing I'd say is you want to start with property with probably like the easiest, like most boring, like highest probability of success, right? So maybe you buy like a new build off the plan, you buy 1 or 2 of those, then maybe you jump to doing something with like an ILSA, where you're doing something where you're adding some value. Like you want to move up in terms of the complexity, right? You don't just want to jump straight into level 10 when you haven't developed any skills or haven't got any experience in the game.
Couldn't agree with it more. And we get those clients that come in that I want to do a development on their own house.
My dad's a builder. He's part-time now. He's got the time to help out.
Yeah, definitely. See it all the time. And that's just not the right way to go. It's like anything in life, right? You can't just go straight into a sport, for example, and be the best. Or you can't go straight into business and do the best job. The same with property. You need to learn.
Yeah.
So what framework would you, like if somebody was thinking about going down this road, what are some tips you'd give them?
Yeah, so for me, it's like do your numbers properly. So often I see people ignore GST as an outcome. So they've got 15% missing from their margin. And to be honest, 15 to 20% is where the margin is most of the time on developments and or trades. So if you mess that up, you've got it wrong straight away. Yep. And then it's just be realistic about time frame and about cost, because you guys will know this. I know this. Everyone who's ever done anything property-wise will know it takes twice as long as you think it is and it costs twice as much, and that's just the rule.
Yeah, I just look back at hindsight on what we did and what we thought it would be. Just being like, how did we ever think we were going to get that much stuff for that price?
I think the other thing is if you're looking at stuff on TradeMe, and you're out there in the market looking for properties, and you think, man, this is an absolute stunner. This is such a bargain, but it was listed 6 months ago. But now I can't believe no one's picked this up. I must be the lucky guy. 1,000 people have done due diligence on it. There's a reason why no one's picked it up.
100%.
What about the risk matter around, like, say, like you've got to buy at a certain price to make it worthwhile, but as the market starts to move next year, right? Like you undershoot, you keep losing, the market keeps going up, and then it's a fart. I mean, that's another risk of this whole thing, right?
Yeah, and I think that's a risk in property in general. And my rule of thumb with all transactions is get them done as quick as possible. So same with developments, because market risk is a very real risk, and the market, as we know, can go up and down. And usually, good thing for property markets, they kind of go down for a long time and then they go up for a long time. So it's a little bit easier, but it's getting the end or the start of it right.
Yeah.
And a lot of people got caught out 2 years ago because most of us thought we actually had a little bit longer to go. And it changed very quickly. Yeah.
It's good while it lasted, though.
Oh, it was a great time, wasn't it?
Yeah.
All right, so that's flipping for you. Matt, thank you very much.
It's been a
for your
flipping
time
good
today.
time.
Always is.
We didn't flip-flop her out.
Much love to Partners Life for sponsoring this episode. Make sure to subscribe to the channel, give us a review, give us a like, and we will catch you
Next time.
Flip, yeah.